Okay. So far, we have skim-read the question. And I'm aware that each paragraph is a self-contained parcel of information. I'm aware, from looking at the balance sheet, that I've got everything in dollars and that I've got a sub-sub in the context of Heaney. I am aware that I have an impairment review process in paragraph number 3, and that's really all that I'm aware of. On the 1st of December, Mini acquires 70% of BOA. That is the 1st of December 2010. Our accounts are to 30 November 2012. So this combination happened 2 years ago. I'm vaguely aware that there will be a second subsidiary, and so I will need to leave space under here to sort that out later. The purchase consideration is 730. 730 is the same figure as in the balance sheet, so I haven't got to reverse out any gains. That's the straightforward figure that goes in the goodwill. That's very simple, 730. The fair value of the NCI is 295. NCI at fair value means goodwill is in full. The net assets are 835. There does not appear to be any story about that figure changing. It just says it's 835. Retained earnings are, other components of equity are, and the excess of the fair value is due to land. Land is not subject to depreciation. Please label your workings. Not only are we doing net assets, but we're doing the net assets of BOA. Please label your workings. Now, the first 3 numbers of BOA go in very quickly, because the first 3 numbers of BOA are copied directly from the balance sheet, and then we have the share capital being the same number. If I'm going too quickly, please let me know. Please ask me a question. If you're not sure where the numbers are coming from, let me know. But all I've done is read paragraph number 1, and I can see that the retained earnings are 319, and the other components of equity are 27. The fair value of the net assets at the date of acquisition is 835. Now, I have seen plenty of questions where that number changes because it's provisional, because it doesn't include this. So sometimes that number gets changed, not here. There's a balancing figure, which is a fair value adjustment, and this is to do with land. I haven't got a calculator. I deliberately don't have a calculator. It slows me down. Make sure that you're at the right speed by feeding me the numbers. If you want to do a subtotal, you can get the book value, but so what? I just want this number here. This number is how much? 89. If it is inventory, I guess that figure will be nil because the inventory has been sold. But the land is still there. So I'll take the 89 across. If the land was plant, presumably I would have depreciation here. There is no depreciation here. If the question said, what about the deferred tax liability on the fair value adjustment, I would also account for the deferred tax liability on the fair value adjustment. But there is no mention of deferred tax, so I should just shut up and get on with it. What do these 4 numbers add up to? 968. I think it has been a success. Having bought the company at 835, the assets are now 968, So that's a good story of 163. No, 133. 133. So the post-acquisition is 133. 30% of that will belong to the NCI, so we shall post that in a minute. Other components of equity is 10, so that is going to be 70% of that will go to other components of equity in working 6. And then the balance must be to do with retained earnings. The difference between these two numbers is 123. The difference between these two numbers is 123, and 70% of that must go to retained earnings in working 5. I go up and down, but actually in this question you can also go across. There's only one adjustment. I've sorted out the net assets of BOA, very important working. This figure appears on the balance sheet. Yeah, these three have given me my instructions as to how to post later. This is, for the goodwill calculation. I am now calculating my goodwill, and I'm calculating the goodwill for the first time, and this is the goodwill of BOA. The fair value of the parent's investment is uncontroversial, it is 730. The NCI is at fair value, it is uncontroversial. The NCI at fair value, I was given the figure, I'm just trying to find it again, it is 295. The fair value of the net assets at the date of acquisition is 835, that doesn't change. If goodwill is negative, then it's a profit, but what we've got here is goodwill, which is in full, and it is a positive premium. How much is the goodwill? 190. Now, goodwill is subject to an impairment review because we've got effectively note number 3 sort of telling us to sort out the impairment review. So presumably there is an impairment loss, and therefore we will have a year-end figure. And when we do finally work out that impairment loss, 70% of that impairment loss will go to working 5, and 30% of that impairment loss will go to the NCI, will go to working 4. So let me sort out the impairment loss a little bit later. I am now interested in posting. So let me open up my working 4, my NCI. I've got 2 subsidiaries. So I've got an opening balance of NCI in respect of BOA, and the opening balance of NCI in respect of BOA is 295. From working 2, I will bring in the share of the post-act. Now looking at BOA, so far as BOA is concerned, I am committing myself to putting in 30% of 133. You may or may not have the right answer, but if you write in working 2 plus share of post-act, show the percentage, show the number. If the number's wrong, doesn't matter, you'll still get a mark. What is 30% of 133? 40. 40. I'm in a posting mood, so I'm in working 5, I'm in retained earnings. I have the opening balance of the parent company. The opening balance of the parent company is 895. And then you are posting the share of the post-act, and the share of the post-act that we are posting is for BOA. They are entitled to 70% of the post-act. Back to working 2. Here I am working 2, 133 overall, but for retained earnings it's 123. So for retained earnings it's 123. 70% of 123? 86.1. Wow, fantastic. Having sorted out working 5, I'm opening up working 6. This is my other components of equity, revaluation gains, that kind of thing. Other components of equity is 73, picking up here from working 2, plus the share of the post-act. Now the share of the post-act, we are dealing here with BOA, the share of the post-act is 70%. 70% of what? Back to working 2, 70% of 10, 70% of 10 is 7. That's taken me 10 minutes. So I'm a little bit ahead of schedule. So maybe I went a bit fast. But actually, I didn't think it was too difficult. I'm happy to have done it in 10 minutes. My budget was 15. I'm pausing. Does anybody want to see any of these workings again? Yeah? There's lots of space underneath. Paragraph 1. I will come back to, well, no, paragraph 1 is gone. I mean, the only thing really to come back to is the 89, because that will go on the balance sheet. The other figure to come back for is the goodwill when we do the impairment review. And luckily for us, when we do the impairment review, we already know our year-end net assets. Or maybe there's a twist. Paragraph number 2. BOA has bought 80% of Heaney. So it is BOA that has bought 80% of Heaney. And it bought 80% of Heaney on the 1st of December 2011. So this is only 1 year ago. So how long have we been a subsidiary? 1 year. Yeah, the most recent date. We've only been a sub for 1 year. So BOA controls Heaney, Mini controls BOA, so Mini controls Heaney, but only for 1 year. 70% of 80% is 56%. So we can say the group interest in Heaney, the group interest in Heaney in terms of the profits is 70% of 80%, which is therefore 56%, and this therefore gives us a non-controlling interest of 44%. So our split for Heaney is 56-44. And that's, I think, comfortable for us. Cash consideration is 320, check. I can see 320 in BOA's balance sheet, that doesn't need changing. We've got a fair value of 20%, we've got a fair value of 30%, we've got a fair value of 44%. All three figures can't be right. There must be a decision that we make later. Net assets are 362, retained earnings are, other components of equity are, and the excess is to do with land, and policy is to measure NCI at fair value because you're given a fair value. So again, you know, I think this is something that is comfortable. Working 7, I'm moving on. I'm sorting out my net assets. I'm sorting out my net assets of Heaney. This must be at acquisition, this must be at year end, and this must be post. So picking up the three numbers for Heaney very quickly, 225,139, and that represents the shares, the other components of equity, and the retained earnings. You must label your workings. Looking at the information on paragraph number 2, the retained earnings are 106, other components of equity are 20, time to draw breath. Somewhere in note number 2, you are told the fair value of the net assets at the date of acquisition, and the fair value of the net assets at the date of acquisition I make to be 362. If that is provisional, revise it. If that is out of date, bring it up to date. But it's not. It's just 362. Now we are told there is a fair value adjustment on land, boring, done it before. Yeah, and the fair value adjustment there on the land is a balancing figure of 36. I will assume the land is still there, because land lasts forever, take it across. If it was plant, there would be depreciation. If there was plant, there would be depreciation in brackets. If the land had been sold, it would have disappeared. If there's a deferred tax liability, you would have to be told the tax rate, and then you would have a deferred tax story here, but it's just not there. So, you know, oh, I've left some space and not used it. So what? You know, better to leave a bit of space and not use it than to cramp everything up and then realise there's another problem. These numbers add up to 400. Nice round figure must be correct. I can now do the posting straight away. Because I've already got my workings opened up, I'm in a position immediately to post. How much of that belongs to the NCI? 44%. Let's do it. Instead of talking about it, instead of saying, oh, I've got the posting, let's actually do the posting straight away. Now, presumably, in a minute, we'll know what the opening balance is for Heaney. Don't know that at the moment, haven't made that decision yet. But from working 7, they will then be adding the share of the post-AC in respect of Heaney, which is 44% of 38. 18, 17, 16? 16.7. Yeah. I'm not an enormous fan of decimal places. I'll take 1 decimal place. 2 decimal places is kind of pushing it a bit. What's the point? You know, get a life. Yeah, so 16.7 is fine. What else is going on here? Look at other. Other is 5. So 44% of that will go to working 6. Let's do it. Instead of talking about it, let's do it. Let's post it. So here we've got in working 6 coming from working 7. Yeah, plus the share of the post-AC, plus the share of the post-AC. And this is, come on, Tom, keep your concentration levels. That's 56, isn't it? Yeah, 56. So it's 56% of the 5, which is 2.8. Thank you very much. Now that will leave retained earnings. I go up and down, so I get 33. If you want to go across, there's only 1 to go across. So yeah, this is then 56% of 33. So I'm looking at my working 5. Here's my working 5. It's come from working 7. Post it straight away. Plus the share of the post-AC. And the share of the post-AC is Heaney. And the share of the post-AC in Heaney is 56% of 33, which is 20? 18.5. Excellent, excellent, excellent. I've done my net assets of Heaney. Next up, goodwill. Danger. Heaney is my sub-sub. Yeah, mustn't get this wrong, mustn't rush this too much. Heaney